So the big question is this: how do investors like us who trade options and manage our own money generate income regardless of where the stock market goes, and do it all in a way that lets us make time for the people and things we love, and yet still build wealth and remain profitable? That's the question, and this podcast will give you the answer. I'm your host, Kirk Duplessis, and you're listening to the Daily Call from Option Alpha. Hey everyone, this is Kirk here again from Option Alpha, and welcome back to the Daily Call. Today I want to talk about why I've been lately referring to myself as a volatility spread trader, because I do think that option sellers are volatility spread traders. And this actually comes about because I've said this time and time again, but I have a really, really tough time trying to explain to people what I do when they ask. So I'm not a teacher. I don't work for the government. I'm not a police officer, right? Like, it's very easy for people to usually explain what they do to people. But when people ask me around town, or if I'm in like some, social setting, people ask me what I do, it's very hard for me to explain what I do. I just trade options. But lately I've kind of like thrown them through a loop, and I talk about being a volatility spread trader. And I thought this was interesting because I was trying to explain to somebody the other day outside of a wedding, what we try to do at Option Alpha. Like, what is our edge? What are we trying to do? And ultimately, it's just this. It's just trying to capture a spread between different volatility prices, basically. The implied volatility price and then the realized volatility that happens closer to expiration. So I think as option sellers, that's really what we do. That could be our title, if you will, is volatility spread traders. We're trying to trade the spread between two opposing price structures and trying to make a profit with the differential between them, or the margin between them. This would be no different than like a house flipper who buys a house at a low price and fixes it up and sells it at a higher price, or would be different than any other business that buys something and their cost of goods and cost of input is lower than what they can sell it for at a profit. It's just a margin. It's just a spread that we're trying to capture. And in this case, I think as option sellers, we have to realize that our true and real edge still lies in volatility, the pricing of volatility, and the differential between what's implied, what people think is going to happen right now, and what actually happens when we get closer to expiration and the markets kind of play out their situation. So I think it was interesting. So let me know if you guys like this or not. Anyways, until next time, happy trading. Thanks for joining us on the Daily Call. Be sure to subscribe right now for more daily options trading ideas, strategies, and tactics to help you learn how to place smarter, more profitable trades. And if you like what we're doing, don't forget to give us a rating and a review so we can continue to bring you the best daily content possible. We'll see you again tomorrow, right here on the Daily Call from OptionAlpha.com.